Welcome to Clear Perspectives, the Marietta third quarter 2026 economic and financial market outlook. Today's Friday, July 10th. The second quarter was a reminder to us of really just how quickly markets can shift from crisis to recovery. It began with the war in the Persian Gulf and the largest oil supply disruption in history. While a final resolution to the conflict with Iran, it remains uncertain. We think the worst case economic outcomes have not materialized, and oil prices have fallen well below their spring peak. This removes a major threat to global growth. So now we're entering the second half of the year, and the focus is shifting away from geopolitics back toward inflation and monetary policy. That's really the backdrop investors are facing today: a resilient economy and strong markets on the one side, and persistent inflation with tighter central bank policies on the other. Let's start with the US economy. The labor market was a real source of concern in our last few outlooks, but here conditions have improved meaningfully during the quarter. Job growth remained solid and unemployment stayed stable, and that suggests to us an economy that remains on firm footing. At the same time, consumers are still facing real pressure. Wage growth has not kept pace with inflation, and that means that purchasing power for many households continues to erode. This helps us understand why consumer sentiment remains near historic lows, even as overall economic growth is steady, albeit not spectacular. Our expectation here is that the US GDP growth settles around 2.5% in 2026. The swing factor is inflation. Headline inflation moved higher during the quarter, largely driven by that energy spike. And a key question for us is whether inflation broadens beyond energy and becomes embedded really throughout the economy. If core inflation remains contained, we think this setback will likely prove temporary. But if it doesn't, inflation becomes a more meaningful headwind for both the economy and financial markets. We've now also entered a new era at the Federal Reserve under Chair Kevin Warsh. At his first meeting, the Fed left interest rates unchanged, but delivered a notably hawkish message. The commitment to restoring price stability was clear. Markets are increasingly debating the possibility of future rate hikes, but our view varies slightly from consensus in that we think the Fed is more likely to rely on messaging first before taking specific action. As a result, the economic data coming out, particularly the inflation reports coming, will likely drive market volatility. Turning to equities, global markets staged an impressive recovery from the early spring sell-off. Earnings drove the recovery, and the results were exceptional. S&P 500 full-year earnings are forecasted to rise about 24%, and the projections for next year are almost 17%. The primary driver of this earnings growth is investment in AI infrastructure. So what that means is that much of the market earnings growth, it remains concentrated in a very small group of companies. And we're also finding that a growing share of this AI investment is being financed with debt rather than cash flow, and that's a little bit of a concern for us. Overall, we are constructive on earnings, but we're genuinely watchful on valuations, concentration risk, this new use of leverage, and a Federal Reserve that is no longer providing a tailwind. This is a market that will reward discipline and selectivity. International markets, they also benefited from the lower oil prices that we saw throughout the quarter, although tighter monetary policy, particularly from the European Central Bank, remains a headwind. Overall, the case for international equities has improved on the margin, but not enough for us to meaningfully change our outlook. In fixed income, our view remains consistent. We continue to favor high-quality bonds with short to medium maturities. We really think that's the sweet spot where investors can earn both attractive income without taking excessive duration or credit risk. Overall, where does this leave investors? The economy has proven more resilient than many expected. Earnings are robust and geopolitical risks have moderated. At the same time, inflation remains unresolved and the Fed has become more hawkish, and market valuations leave almost no room for disappointment. In our view, this is an environment where discipline, selectivity, and a true long-term perspective remain as important as ever. As always, thank you for watching, and I look forward to updating you next quarter.